Bear with me here. I know this can be hard going. Now we move on to fiscal policy. Fiscal policy is the use of government spending and revenue collection to influence the economy. The two main instruments of fiscal policy are government spending and taxation. Changes in the level and composition of taxation and government spending can impact on the following variables in the economy: aggregate demand and the level of economic activity, the pattern of resource allocation, and the distribution of income. Fiscal policy refers to the overall effect of the budget outcome on economic activity. The three possible stances of fiscal policy are neutral, expansionary, and contractionary. A neutral stance of fiscal policy implies a balanced budget where government spending equals tax revenue. Government spending is fully funded by tax revenue, and overall the budget outcome has a neutral effect on the level of economic activity. An expansionary stance of fiscal policy involves a net increase in government spending through rises in government spending, a fall in taxation revenue, or a combination of the two. This will lead to a larger budget deficit or a smaller budget surplus than the government previously had, or a deficit if the government previously had a balanced budget. Expansionary fiscal policy is usually associated with a budget deficit. And we can see clearly that is happening in the US, the UK, European countries, and across the world. The reaction to the financial crisis was one of monetary policy, so reduction of interest rates, increasing the supply of money, but also fiscal policy, which was to use the budget of the country to increase stimulus into the economy, creating jobs and driving demand. A contractionary fiscal policy occurs when net government spending is reduced, either through higher taxation revenue, reduced government spending, or a combination of the two. This would lead to a lower budget deficit or a larger surplus than the government previously had, or a surplus if the government previously had a balanced budget. Contractionary fiscal policy is usually associated with a surplus. So to relate that to the credit crisis once more, in 2008-2009 we can see that most governments adopted a strong expansionary fiscal policy in combination with an expansionary monetary policy to restore order to the global marketplace. The stimulus packages from the UK, the US, Europe and China were huge fiscal measures designed to boost employment and to keep the economies afloat. Investment in internal infrastructure, technology and green science were designed to provide jobs and reduce the huge surge in unemployment due to the restriction of capital. Also, huge investments in the banks to stop them collapsing ensured the continued functioning of the financial systems. This was absolutely critical to the future of the UK and the US, who between them, the City of London and Wall Street, are essentially the superpowers of the financial system. However, this rescue came at a price. The debt burden on the US and UK particularly will need to be dealt with in the future. And this is important for the stock market investor. This correction from the expansionary fiscal policy to one of contractionary to reduce the debt burden will be difficult and can only be done when business and the consumer are strong enough to stomach the change. The stock trader, you, need to keep an eye on this to be able to assess what impact this will have on the overall market. If the government start to increase rates, restrict their investment, this might have an effect on the stock market, and you need to be critically aware of this, whether you invest in ETFs, mutual funds, or stocks. When the overall market is going down or consolidating sideways, there are less opportunities for profiting. Summary. Why did I put you through the ordeal of understanding monetary and fiscal policy? There is one really good reason. Understanding the direction of the stock market is of absolutely vital importance to being able to make a profit in stock trading. If you buy stocks, ETFs, mutual funds during a period of economic recession, your chances of making any money at all are dramatically reduced, and you will probably lose money. Keep tabs on the prime rate, unemployment, government debt, and the health of the consumer, lending and spending. An uptrend in the prime rate, especially approaching 10% or higher, is likely to bring stagnation to stock market returns. When interest rates are higher, the stock market as an investment tool sees competition from money market funds, certificates of deposit, and treasuries, which will have a higher yield and lower risk. Then money inevitably flows out of stocks into other investment vehicles. The first rule of the best traders in the world is do not lose money. If the economy is starting to smell like old milk, you need to be in cash. No questions asked. In later chapters, we look in depth at the subject of market analysis, and this will become part of your daily routine, to the point where you will not even want to buy stocks when a market is starting a minor downtrend. The fact is, as Jesse Livermore famously said, the essentials to stock market success are knowledge and patience. I will provide you the knowledge. Only you can learn patience.